Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. The final push, Donald Trump and Kamala Harris sweep through Pennsylvania, trying to find an edge in the key swing state ahead of tomorrow's election. Investors firmly in risk-off mode before what could be the tightest White House race in years. This week's Fed decision also in focus, and the RBA set to stay on pause this hour. We'll talk about the market and economic implications of delayed or even disputed U.S. election result, which JPMorgan and PwC, plus a closer look at the record foreign exodus from Indian stocks now on the verge of a technical correction. It's the final countdown, with Asian stocks in holding pattern as investors await the U.S. election result. Polls are showing American voters evenly split between Donald Trump and Kamala Harris. The likelihood of a disputed result may drag the vote count out for weeks or even months, spurring a potential rise in volatility. There are, of course, additional catalysts, as Election Day will quickly be followed by the Fed decision. Here in Asia, attention is on the second day of China's meeting of the NPC, where those big stimulus checks are due to be signed. And we're keeping a close watch on Indian equities tumbling towards a correction and ending their run as one of the best performing markets in the world. Now, let's get more on how the U.S. elections are shaping up as Kamala Harris and Donald Trump make their last-ditch attempts to convince voters. Bloomberg's Vonnie Quinn joins us now from New York. It is a tight race. They're still campaigning. Where are we at right now, Vonnie?
It is still election eve, Haslinda, if you can believe it, another couple of hours here on the East Coast, and that is where, for the most part, candidates have been campaigning all day. Pennsylvania specifically, one of the very key swing states, which of course went for Biden in 2020 but didn't go Democrat in 2016. Trump won Pennsylvania in 2016. So Kamala Harris right now on her way to Philadelphia, where she'll be rallying with the likes of Lady Gaga, Ricky Martin. She's just on a rally with Katy Perry. President Trump stayed in Pennsylvania for most of the day and then went to Grand Rapids, Michigan, where he has finished off his campaigns in previous eras. But of course, as you say, all to play for. Slight tilt towards Kamala Harris's advantage in some recent polls, particularly one that got a lot of attention today, and that was a poll out of Iowa by a very respected pollster, which showed Kamala Harris leading what is always a red state, Donald Trump, by 4 percentage points, which is outside the margin of error. Now, no one is suggesting that Kamala Harris is going to win Iowa, but directionally, it definitely provided some momentum for the Harris campaign. As for the closing types of arguments, we are hearing some kind of negativity from the Trump side. He's suggesting that he has won the election already, which could be potentially setting us up for some legal challenges ahead should he not win in the first or second counts. And then on the Harris side, you have very much a message of positivity, coming together, getting out and voting, because if there are still 1 or 2 undecided voters, they only have a few hours. Those polls open in about 8 hours.
Well, the big question, Vonnie, is when might we see some indication of those results?
Well, actually, Haslinda, we could know very early, at least some of the safer states, right? We may know very many of the states within just a few hours of the polls closing. The 93 electoral votes that are all to play for, though, those swing states, well, that's anybody's guess. We could have automatic recounts in Pennsylvania or Arizona or anywhere where it's going to be very close. And then we could get the same thing in some states like, for example, North Carolina, which has also gone to Trump in previous eras, but may not this time round, according to polls, because we are neck and neck in really virtually all of the polls that we are seeing. So last time round, it took until the Saturday for us to have a result. This time around, it's really anybody's guess. As for the House and Senate, though, the down ballot votes, we may know the Senate pretty quickly. Some of those seats are up for grabs, but many of them are sort of almost decided upon. Some of the House votes, though, will take longer because they're in California, and of course, there's a 3-hour time difference.
All right, Vonnie, we wait with bated breath. Bloomberg's Vonnie Quinn in New York. Thank you so much for that. Well, as the final hours of the campaign tick down with everything still too close to call, Volatility is the watchword. So how are investors navigating the uncertainty? Joining me in the studio is James Sullivan, JPMorgan head of Asia Pac Equity Research. James, great to have your insights here today. I mean, when we talk about the polls, it is split down the center. When we talk about the markets, it's been pretty clear. I mean, we've seen some gyrations in recent days, but it is a Trump win for the markets.
And I guess what's interesting, Haslinda, is across the various prediction mechanisms, from polls to prediction markets, everything has basically settled in the 50-50 split category. As you say, markets have been very different, and what's interesting to me is that's been true across asset classes. So at JPMorgan, we run stock baskets to try to help us better understand sentiment on various thematics. We have a basket that's designed to benefit from the Democratic win, one for a Republican win. The Democratic basket is sitting at a 7-year low, and the Republican basket is sitting at a 2-year high. If you look at what's priced into rate markets in terms of inflationary expectations, you've seen a dramatic repricing of inflation expectations in derivative vehicles like interest rate break-evens, where you've seen an over 100 basis point increase in inflation expectations, which is more consistent with a Trump victory than a Harris victory. So across asset classes, you do have a relatively clear view expressed in markets.
Well, the thing is, the markets could be wrong. We had Professor Lichtman just yesterday saying that, I mean, of course, this is a man who's predicted rightly 9 out of the 10 elections, and he says it's going to be a Harris victory. How do you square that, and how do you position for that?
So I think it's very clear. If you do have a Harris victory, you'll have more volatility in the short term in both equity rate and derivative markets than you would with a Trump victory, again, because that Trump victory is more in the price than a Harris victory right now. But what I do think is absolutely critical for the forward view is ultimately, do you get a, quote, red wave, blue wave, or divided Congress? A divided Congress, frankly, is generally better for markets because it prevents the extremes in either direction. And that's really critical to understand as we go through the next 48 hours. Where does control of the Senate end up? Where does control of the House end up? And if that does split, that presents a very, very different picture than this red or blue wave scenario.
Where are the mispricings? How do you play that? Where are the opportunities?
So I think it's very clear that a Trump administration will generally be, if the tariffs are implemented, will generally be a more inflationary environment. You will see higher rates for longer out of the U.S. Fed. All of that generally is conducive to a strong dollar environment. From an Asia market perspective, that's not a great setup. Asian markets underperform 80% of the time in a strong dollar environment. And so that is something that we're watching very closely. You also start to differentiate country by country. If you get 60% tariffs placed on China, as an example, that has a dramatic impact on both currencies and the potential forward for the RMB, which could, in theory, go to 8-9 to the dollar, depending on where the tariffs end up. But it also has a bearing on GDP growth in China, the U.S., and the world. If all of the tariffs that have been discussed on the campaign trail are implemented, which is by no means a guaranteed outcome, then you're looking at 70 basis points taken off global GDP estimates. And so again, there's a wide range of outcome depending on who controls which branch of government, but also which policies are actually implemented. A lot is set on the campaign trail. We have to see what's actually
So how much of that would the Fed have to consider? I mean, that Fed decision coming straight off the bat.
It's a great question. And look, I think the answer is given to us by Chairman Powell in the public pronouncements, which is they will follow the data. And at the moment, we don't know what policies will be implemented. We don't know what will actually be put into place from a legal and regulatory perspective. So I do expect them to take a relatively cautious stance. JPMorgan, as well as many others, are predicting a 25 basis point rate cut. Beyond that, I think the commentary will be very cautious given the uncertainty moving forward.
And the dollar?
The dollar, I think, will remain strong for a period of time. Again, the outlook for the dollar in a Trump administration is, on JPMorgan estimates, for a stronger dollar than under a Harris administration. So that will be a market that we're watching very closely, both dollar as well as rates.
All right. James, hang tight. We'll have more of James's insights in just a moment. Still to come, a closer look at the U.S. presidential candidate's economic policies. Hear why PwC's chief U.S. economist is sounding the alarm of America's fiscal deficit problem. Keep it here with us. This is Bloomberg. Welcome back. Chinese equities are getting a boost from a pickup in services growth, as shown by a private survey. The Caixin Services PMI expanding at the fastest pace since July, a sign that consumer demand is looking up after Beijing's recent barrage of stimulus measures. Chinese Premier Li Qiang just moments ago expressed confidence that his government can pull off an economic recovery. Now, as China's equities show signs of a rebound, the Indian market seemed to be fast losing favor. India's benchmark Nifty index approaching a technical correction as foreign investors sell a record amount of shares. Avril Hong is here with more. Seems like losing all the love, those Indian stocks.
Yeah, they are losing favor, Haas. I mean, this is a market that has gotten a lot of love in recent years, whether it's the belief in India's growth story or the shift away from China. We are seeing the Nifty now 8.5% down from the September peaks, but it is still up 10% for the year. And what we're seeing recently is partly to do with earnings disappointment in India, but also against the backdrop of the September stimulus blitz from China. But note as well, when you take a look at India's valuations, they are still among the priciest in emerging Asia. I think on the Nifty, if you look at the forward earnings and how it's about 21 times to the 12-month forward earnings, I should say. Let's flip the board and take a closer look at what we're seeing among the global funds, because for the month of October, they sold the most amount of Indian shares on record. This is even surpassing what we saw back in March 2020 during those sudden lockdowns. But it's not as clear-cut as just because of that return to China, because when you look at some of the Goldman analysis and the hedge funds, how they have been actually cutting their China bets, both long and short, at the fastest pace since 2021, it gives you a sense that there's more than just that rotation back towards China. Take a closer look at what we're seeing in India earnings, and so far this season, what we've been seeing from the companies that have been reporting is misses, and this is across most industries, including consumers, including financials. We're also seeing signs of an urban slowdown, and consumers in these cities just pulling back on spending. And to the likes of Bloomberg opinion columnist Andy Mukherjee, this speaks to perhaps how India's wealth income inequality is starting to bite. So there are a lot of other factors at play as well, Haas.
So reversal in sentiment in India. Avril Hong, thank you so much for that. James Sullivan, still with us. JPMorgan's head of APAC equity research. How can you not love an economy that's growing at 7%?
So I think there's two stories here, at least from a JPMorgan perspective. Story number one is the fascinating thing about markets is they're driven by psychology as much as they're driven by fundamentals. And the reality of India is that for most foreign investors that had participated in the rally, it was one of the best performing markets in Asia. It was relatively expensive, and we're walking into the biggest geopolitical event of the calendar with very significant spikes in volatility across all asset classes. And so the willingness to degross as you go into the U.S. election and take profits and book those profits in your portfolio, I think is very, very clear and understandable. Story number one. Story number two, and this is interesting for all of Asia, is the rising importance of the domestic institutional investor. And so you had roughly $10.5 billion US dollars of foreign institutional investors selling in the prior month. You had almost $13 billion of domestic institutional investor buying. And that's been a consistent trend across Japan, Korea, India. And the rising importance of the onshore institutional investor is something that we're watching very critically. When I talk to investors, institutional investors in India, the common refrain is, look, we understand it's expensive. I just had $150 million come in, and I got to buy something and put that money to work. And so the wall of money that is pushing a lot of our domestic markets across Asia is a very interesting part of this conversation.
What's also interesting is the conversation that people are taking money out of India to put it into China, yet we're also getting reports that hedge funds are pulling money out of China. So how do you square that?
The rotational trade back and forth between India and China is something that we've talked about for years. I think the reality today is, from a short-term catalyst perspective, we obviously have the NPC meeting underway right now. Haibin Zhu, who is our chief China economist, is forecasting that you're not likely to get very significant positive surprises out of the NPC meeting. He's instead looking to the China economic workforce meeting in December, in which case you potentially have some short-term disappointment, which I think explains some of the selling. we're trying to take a balanced view on the China economy. On the one hand, you do have stimulus, which is starting to inflect some of the macroeconomic indicators positively. That said, we do not yet see a U-turn in policy away from production and towards services, away from manufacturing and towards consumption. And so I think we need to be very balanced with what we think will the impact, and particularly the economic multiplier impact of the stimulus is likely to be in China.
We heard how Li Qiang was confident that they will achieve their growth target for the year, and we're seeing a lot of stimulus, 10 trillion yuan worth, by some estimation. And is that enough to perhaps boost that rally? Is this just the beginning of the China rally?
If you are anyone within the Chinese government right now, I would be shocked if you are not watching the next week with trepidation, because you don't know what policies you'll get out of your largest trading partner in the world. You don't know your ability to continue to export at scale to specific countries. And if the basis of the Chinese economic model is still export of excess capacity, which I believe it is, then that's a very meaningful part of this conversation. And so it would absolutely make a lot of sense for the Chinese government to be keeping some of their stimulus powder dry in expectation and trying to understand what's going to happen out of the United States. And so I don't think we've seen the last of the announcements. I would be very surprised if you get very meaningful surprises out of the NPC meeting rather than waiting to see the outcome of the U.S. election.
So you're saying that by keeping its powder dry, it will have the ammunition. Does it have enough ammunition if Trump were to come to power and impose that 60% tariffs on Chinese products?
So it's a challenging environment, and ultimately we continue to hold that we need to see this pivot away from manufacturing and towards consumption. Again, as we just discussed, we haven't seen that U-turn yet, but we could potentially see more meaningful structural reform post-U.S. election.
So India versus China, how should they factor into your portfolio?
So from a portfolio construction perspective, we're overweight India and neutral China. That said, one thing that, and of course I'm going to say this because I'm a company analyst and not a sector strategist, but look, I think everywhere it's absolutely critical to look beyond the index and to look to the underlying bottoms-up drivers, because what we're seeing right now, in particular moving forward from a macroeconomic perspective, you're not seeing that unitary shock that's going to push everything in one direction. You're not seeing the beta trade, you're seeing the alpha trade. So really digging down to the underlying sectors is absolutely critical. And we need to see the outcome and have a better forecastability of US dollar, US rates to start to bifurcate those outcomes moving forward.
Of course, it's not just about India and China. It's also about, economies like Japan, which has come into focus these days. And, there's a lot of attention to it, a lot of interest in it. How are you assessing the BOJ moves, and how are you assessing the impact of the U.S. election on the Japanese market?
So let's talk Japanese economy and then the U.S. impact, particularly on the yen. From a Japanese economy perspective, I think there's two elements to discuss. Number one are the Tokyo Stock Exchange reforms that we saw issued over the course of the past 12 months. Those are absolutely having an impact. You're seeing a 90% increase in year-on-year stock buybacks, as an example. So you're seeing significantly better capital allocation decisions and significantly more shareholder-friendly policies coming out of a whole range of Japanese corporates, which is positive for overall market performance, given the relatively inefficient balance sheets that we see in many countries around Asia, Japan inclusive. The critical issue that we're watching very closely is, again, depending on the forward for the U.S. Fed, that will have a meaningful impact in terms of the Japanese yen. What we're seeing in the underlying economy is earnings expansion beyond just yen depreciation. That's absolutely critical because you're seeing productivity gains and you're seeing price increases that companies are pushing through to the end consumer, which is overall positive for Japanese inflation, but it's also positive for the margin profile of Japanese corporates. But we really need to understand the future directionality of the yen to take a complete picture.
And what assumptions are you making about yen path?
It will depend on who wins the U.S. election, again, because the critical nature of...
But you're saying as well that fundamentals are intact.
They are. They are. And so the base case scenario in Japan, I think, is quite positive, not only from a fundamentals perspective, but also from a corporate finance perspective, as you see these more shareholder-friendly policies being pushed forward.
But, James, the uncertainty also lies in the government and the formation of that government.
Yes.
I mean, how do you see that influencing investor psyche and investor decisions?
We do think we'll see a coalition government formed and a continuation of most of the existing policies. The critical aspect, which is interesting in the Japanese context, in most markets, if you see a coalition government, you would expect to see an increase in fiscal impulse because you have a broader coalition and you have to keep more coalition partners happy. In the case of Japan, that's actually positive because then you're pushing pro-growth policies into the Japanese economy.
Okay. Now, in terms of a must-have, key traits conviction trades in Asia, what would they be?
So I think the critical element from my perspective is to look through the short-term volatility to understand what are the duration trades that make sense from a bottoms-up fundamental perspective that we do think we will continue to see moving forward. And I would continue to highlight India. As we discussed during the break, you're seeing disappointing economic growth of 7%, best in global emerging markets. And that growth scarcity, I do think, is a very meaningful part of the conversation moving forward, particularly as we continue to realign global trade patterns, which is not productivity enhancing, which is not growth enhancing. And so markets like India, which have structural bottoms-up growth opportunities, will continue to get a significant premium. Companies that can control their own destinies with shareholder-friendly policies, as we just discussed in Japan, are also extremely interesting.
You know, when it comes to emerging markets, that promise has always been there, but they've underperformed since 2010. Would it be any different this time around? Would it be any different in 2025?
So Japan, not necessarily an emerging market, but from a shareholder return policy perspective, again, we are seeing an 80 to 90% year-on-year increase in share buybacks. So we are seeing actionable steps taken by a wide range of Japanese corporates already. We obviously have similar conversations going on in markets like Korea, where they're talking about value up and other nomenclature. We haven't necessarily seen the rubber hit the road there as much as we have in Japan.
All right, James, hang tight. James Sullivan, head of APAC Active Research at JPMorgan, will be staying with us. And here are some of the stories we are following. China's developer Country Garden saw its sales slump moderate in October. Corporate filings showed contracted sales for the month fell over 30% to some $600 million. That narrowed from a more than 40% on-year drop in the previous month. China's been introducing measures to jumpstart the economy and the property sector. Tesla's Shanghai factory delivery slipped in October. Data from the China Passenger Car Association shows a sharp 23% contraction from the prior month. The sales dip may impact Tesla's guidance to deliver a record number of EVs this year. The numbers are an outlier, with rivals BYD, XPeng, and Geely posting record sales. And Palantir shares soared in late trade after it posted record profit and quarterly revenue that beat analyst estimates. The company also raised its forecast for the current period. CEO Alex told shareholders in a letter that Palantir is meeting unwavering demand for what he calls a US-driven AI revolution that's reshaping industries and economies. And sources say OpenAI is having discussions with Californian regulators on advancing its bid to transform into a for-profit business. We're told the $157 billion company is in early talks with the Attorney General's office about the process that's likely to involve scrutiny of how OpenAI values a portfolio of highly lucrative intellectual property, such as its ChatGPT. In the markets, well, tepid performance as we count down to that U.S. election. Trepidation. It is a close call where polls are concerned, down right the middle. Well, we'll have, of course, we have the likes of crypto performance in the lead up to those elections, suggesting perhaps it is a Trump win, but not the case in recent days. MSCI Asia-Pac Index up 0.3%. Coming up, we discuss the outlook for Australian markets as we await the latest rate decision from the RBA in a few minutes. Keep it here with us. This is Bloomberg. We're keeping an eye on Aussie assets as we count down to that RBA decision. It is expected to stand pat at 435, which is the highest in 13 years. Of course, this is an economy that is still struggling with sticky inflation. Eco data so far has been pretty mixed. And of course, in terms of the markets, we've seen how Aussie stocks have had a run up in expectation of rate cuts, which some say may not be coming till February 2025. Taking a look at where the Aussie dollar dollar is trading right now against the USD. It is up a marginal 0.1% as we count down to that rate decision. Front and center, of course, what the RBA might indicate. Would it be a cautious, hawkish tone that we're expected to see from the RBA, the need for restrictive policy as CPI remains pretty elevated in the country? Economists also waiting to hear discussions on China, in particular, of course, the exposure of the Aussie economy to China is pretty large. Some say that perhaps at least 30% of the economy is reliant on China, and there's been trepidation on how the Chinese economy is recovering. Again, we're awaiting the RBA decision, expected to stand pat at and we have that cash rate standing pat at 4.35%. As expected, we await to hear the comments from the RBA. James Sullivan, head of APAC Active Research, is with us as expected.
So I think there's two elements to watch in terms of the underlying commentary. In terms of the global rate environment, as we discussed previously in the program, you've seen a pretty dramatic change in outlook for U.S. rates and U.S. inflation. Inflation break-evens have added almost 100 basis points of inflation expectation over the course of the past 30 days alone. And you've seen a 50 basis point increase in long rates in the United States, which gives the RBA more scope to leave rates higher for longer because they don't have to worry about the currency implications of cutting rates depending on where the U.S. Fed ends up. As you very rightly say, there's a large component of the Australian economy leveraged into China. And again, we have significant policy uncertainty. If you do get a 60% tariff applied to China, on our estimates, that takes 200 basis points or 2 percentage points off China GDP growth, which will have an impact on the demand function for Australian metals and mining, consumer goods, et cetera.
Given all those factors, it is quite surprising that Australian stocks have done so well. They're among the best performers, along with Indian stocks and Canadian stocks. I mean, could investors be running ahead of themselves? I mean, could we see a pullback?
I think it's certainly possible. And one thing to focus on, at least from a JPMorgan perspective, is the recent earnings cycle. And we've seen significantly more misses than beats across a wide range of sectors, which isn't conducive for stock market performance moving forward. So we are being very cautious with Australia.
So what do you do with Aussie stocks, James?
I think we have to be very cautious, particularly in the metals and mining space, on the back of potential weakness in China demand. Again, our estimates are you potentially see a downdraft not only of 2 percentage points out of China growth, but potentially 70 basis points out of global growth, which is not positive for the metals and mining space. Companies that are more focused into domestic demand within Australia, particularly given a relatively flat rate environment, are probably a better vehicle to play moving forward.
Of course, investors are hoping to see that rate cuts, and some say not until February of 2025. What kind of movements do you see from the RBA?
Again, I think most central banks are continuing to focus on the data. And at this stage, there's a lot of data points that remain unknown.
Not to mention the focus on the Fed.
Correct. And that's one of the data points that non-U.S. central banks need to continue to focus on. And that is a very volatile forecast right now. As we've seen the last 30 days, you've seen a very, very significant movement, not only in rate, but also inflation expectations out of the U.S.
You know, we've seen a repricing of the Fed. I mean, you got to wonder how central banks in Asia are looking at that.
To some degree, it gives them less ability to continue to cut rates without taking a hit on the currency side of things. And so, unfortunately, for a lot of the Asian central banks, they need to continue to take their ultimate cue from the U.S. Federal Reserve because of the currency issues in many, many Asian markets, particularly those that are either running a current account deficit or those that are more export-oriented.
So which crosses are you most concerned about with the dollar expected to remain resilient for some time at least?
We don't see significant rate cuts across most of the major Asian markets. The currency trades that we're most concerned about at this point have less to do with rate differentials and have more to do with currency sterilization of particular policies. And so as an example, if you do see significant tariffs applied to China, you could see RMB moving significantly weaker than where we are right now, breaking 8. If they want to fully sterilize the tariff impacts, you're talking about 9+, which is not what our forecast is, but potentially very significant volatility there. The other cross that we're looking at very closely is US dollar yen. Again, depending on what happens on the forward with the US Federal Reserve rate cuts, you could see the yen breaking above 150 again, which again will have differential impacts by sector in the Japanese stock market.
And what's fair value for the yuan as well as the yen?
For the RMB, we're looking currently at about 7.4 from a short-term perspective. For the JPY, we're looking at somewhere around 145, 147.
And the biggest risk for Asian economies right now, I mean, what would that be? I mean, post-election, I mean, right now, the election is key, but post-election, what would that be? The policies from Trump, I imagine, if he comes to power, and perhaps even Kamala Harris, who's, if we consider what Biden did in terms of continuing with Trump's policies.
Trump, I think that's absolutely a core area of focus, but I do think it's important to come back into region and recognize there are a lot of things that countries can do to control their own destiny. And we've talked a lot about the potential stimulus policies coming out of China. The critical element of those is A, the size, B, the focus. As we've talked historically, if you use those stimulus policies to jumpstart the Chinese consumer, you have a significant multiplier on those stimulus funds. If the stimulus policies continue to support industrial production, there's very little multiplier. You have to push more stimulus after more stimulus. And so there are significant efforts that Asian governments can take to stimulate and to manage their own economies separate and distinct from the U.S.
If you were to hazard a guess on the best performer in terms of market in 2025, what would that be? Might China surprise on the upside?
It absolutely can, because if you do have a meaningful stimulus program that continues to push what are our strengthening macroeconomic numbers, that's a critical component to the conversation. We had a geopolitically focused dinner on Saturday night with a whole range of representatives from investors to government officials this past Saturday. And the critical part of the conversation came out, for all of the doomsaying, like let's recognize China is still second or largest economy in the world. They're still growing at a reasonable rate for a very large economy. There are a lot of good things to focus on from a market's perspective in this conversation, and there are a lot of subsectors that could experience significant outperformance, which we've already seen. I mean, you've had the internet space up very significantly. You've had some of the consumer players up significantly on a year-to-date basis. And so, again, my bias as a company analyst comes to the foreground. There's always companies to buy for outperformance, and there's always bottoms-up stories that are likely to perform regardless of what the overall macroeconomic environment.
And also, I mean, despite the run-up we've seen in China, valuations remain pretty attractive.
Valuation remains extremely attractive, but also from an investor positioning perspective, most investors are not aggressively participating in this market. The other market that I would throw out there that might surprise on the upside, despite valuations, is India. Again, foreign participation is very, very low. You had India as one of the best performing markets in the region. Okay. The assumption was strong foreign participation. That never really happened. And so if foreigners do come in, you have another leg higher in that market.
All right, James, thank you so much for your time today. James Sullivan, head of APAC Equity Research at JPMorgan. Still to come, more on the countdown to the U.S. election. We'll get insights from PwC Chief Economist Alexis next. Keep it here with us. This is Bloomberg. Welcome back. Chinese Premier Li Qiang has expressed confidence that his government can pull off an economic recovery while also taking an apparent jab at the US and EU over trade. Li was speaking at the China International Import Expo in Shanghai.
The Chinese government is capable of sustaining sound economic development. Facing downward economic pressure, we are well equipped to intensify counter-cyclical adjustments. We still have ample space for both fiscal and monetary policies and more policy tools at our disposal.
Our Chief North Asia correspondent Stephen Angle is at the CIIE. He joins us now. Steve, obviously great news for the markets. We're seeing Chinese stocks leading the pack today.
That's right. Look, a lot of the Chinese officials, whether it's Li Qiang, the vice finance minister last week telling Bloomberg, or now, of course, Li Qiang, the premier, essentially the head of the economy here in China, giving hints that some stimulus, further stimulus is on the way, and that they're also going to hit that target of GDP growth of around 5%. Of course, those projections were in serious doubt through the second and third quarters as they delivered below 5% GDP growth. Third quarter was even worse than the second quarter. But then we had at the very tail end of the third quarter in late September, we got a raft of stimulus, unprecedented in many ways, that has helped lift sentiment and also into targeted industries that could perhaps lift the fourth quarter and therefore hit that target of around 5%. That's why I think the markets are cheering as well some of Li Qiang's comments about having ample room fiscally and monetarily to stimulate even further. He said China has ample room in monetary and fiscal policy. China is able to drive economic recovery. China has conditions to ramp up counter-cyclical adjustments, ramp up ample room. These are words that the markets like because, again, some of that stimulus fatigue has set in. They're waiting for some sort of fiscal number. We already got word yesterday that the National People's Congress Standing Committee meeting in Beijing behind closed doors until Friday, already talking about a debt swap program at the municipal level to alleviate that hidden debt issues and the burden, the fiscal strain that is at the municipal level that really was exacerbated by the COVID-0 policies, and the expenses really went higher. With a slowing economy, with the property trouble, they haven't been able to essentially meet growth targets. They needed that kind of debt relief from the central government. So that's what they're discussing. But we're also waiting potentially a big number, a fiscal number. We've heard anywhere between 6 to 10 trillion yuan in potential stimulus for housing, for consumption, for bank recapitalization. We don't know.
Steve, the big number is important, is also how stimulus is deployed. And right now, a lack of clarity on that. A lack of clarity as well on the geopolitical front with the U.S. election. We heard from James Sullivan just slightly earlier talking about how China is keeping its powder dry in anticipation of results. China is watching it really closely.
That's right. I mean, look, the elephant in the room here at the CIIE is the outlook and the outcome, I should say, of the U.S. presidential election. Nobody's really talking about it on stage. Li Qiang did not mention the U.S. election, and I didn't expect him to. But he did talk about the protectionist winds abroad. He essentially said unilateralism and protectionism is on the rise. He said China resolutely safeguards the multilateral trading regime. I paraphrase him, but let's hear exactly what he said in sort of a veiled reference to actions, trade actions by the United States, the Biden administration.
The backlash against globalization is picking up steam. Unilateralism and protectionism are clearly on the rise. And global peace and development is confronted with growing factors of volatility and uncertainty. Against such a backdrop, it is all the more important for us to uphold, expand, and upgrade opening up.
And I do think one reason why the National People's Congress Standing Committee meeting was held later this year than normal, it's usually at the end of October, it's now in the first week or thereabouts of November, is because leaders in Beijing are waiting to see who's going to be in the White House in January. Is it Donald Trump and his 60% across the board tariff increase on Chinese imports, or is it steady as she goes with a continuum of Biden policies under Kamala Harris, presumed?
Well, guess what, Steve? We'll know soon enough. Bloomberg's chief North Asia correspondent, Stephen Angle, in Shanghai for us. Now, China, along with the rest of the world, is, of course, waiting for the conclusion of the U.S. election, with a lot at stake in future relations between the two, not least a fresh wave of tariffs should Donald Trump be the victor. Let's bring in Alexis Crow, partner and U.S. chief economist at PwC, who joins Insight from San Francisco. Alexis, good to have you with us. It is a high-stakes election, especially for Asia, especially for China. How do you see this playing out?
Thanks so much, Haslinda, for having me. So it's interesting when we think about the extent to which the American economy is very much uncorrelated currently from other advanced economies. It's really the single engine that's driving advanced economy growth. And certainly we have other bright spots. Earlier contributors have named those, namely in India and also Southeast Asia. We think about the impact on China, and we're braced for the impact on China. One thing that's interesting to note is that since 2005, China has taken its trade as a percentage of GDP, exports as a percentage of GDP, from 34 down to 21%. So really, as the economy is driven more toward consumption, it doesn't necessarily have as much exposure to the pain from a potential escalation of trade war as it would have, of course, back in 2005. If we think about the impact on other economies in the region, such as Singapore, such as Japan, of course, we saw the extent to which these economies were hampered by the crossfire of the U.S.-China trade tensions, and we can certainly forecast that that might escalate should certain parties take the White House come January. And so I think there's also just a little bit of an upside when we think about the third nations, also economies such as Japan and Singapore that have been benefiting from the imposition of tariffs on China over the longer term.
Alexis, to your point, in fact, China's share of global trade has increased since the trade war between China and the U.S. started. Is it a fair assumption to say that no matter who wins, the relations with China will not get any better?
That's absolutely right. You know, Haslinda, when we had the Biden team coming in, our forecast was that you would see a change in tone, but not in stance with regard to the policies on China. And really, this is something that's bipartisan. It's rooted in differing conceptions of the relationship between technology and national security between Beijing and Washington. And that has really only deepened and is very unlikely to ever unfurl. Of course, what we've seen is that that has played out in certain elements of the technology relationship between Beijing and Washington, and it has spilled over into elements of financial services as well. So we have seen some of the U.S. globally systemic important banks and also some of the investment banks start to pull back headcount and exposure in mainland China, and that is concerning in many ways.
Give us a sense of how this might play out in terms of tariffs. Trump has said that he wants to impose 50, 60% on Chinese products. The thing is, China, yes, will be impacted. Some say perhaps a drop of 90% in terms of its trade to the U.S. The thing is, the U.S. will be hurt as well in the process.
Absolutely. And we saw that going back to really the third week of March 2018, when the sparks from the trade war really properly started to fly. And that got passed on to the consumer. Actually, the first tariffs that were put on the pulp coming in from Canada got immediately passed on to the consumer in basic household goods like paper towels in the U.S. So that's when we started to see for the first time CPG companies putting on this cost increase onto the consumer, and the consumer was willing to be able to bear that. There's a lot of doubt right now as to whether or not the U.S. consumer, after multiple inflation shocks over years, also facing a higher cost of housing, healthcare, will be able to stomach and afford successive increases to inputs passed on by manufacturers. And I have a lot of doubt on that.
And of course, it's not just about China, it's about the rest of Asia as well. I mean, Trump's plans to impose 20% tariffs, blanket sweeping, that would impact the lives of India, for instance. I'm just wondering, might this force India's hand? Might Modi be forced to cut its import levies as a result of that?
Well, it's interesting. I think we have to think, Haslinda, about what are the knock-on impacts, right? Not just on tit-for-tat tariffs, but what happens if the U.S. imposes a universal tariff, and other economies respond in kind by limiting purchases of certain things from the U.S. that are not necessarily goods. It could even actually be services. It could be limiting the room for expansion for U.S. multinational corporations. So that's where I think we could get into a tit-for-tat scenario. And we saw that play out a little bit with Europe in the first Trump term. And that had a negative effect on Europe ultimately. If we think about where some of this might spill over, also, it's in the U.S. corporate profit space. So the IT or tech basket of the S&P 500 earns 59% of its revenues from abroad. So if all of a sudden the U.S. unilaterally creates some sort of trade tension and tariffs, then you could potentially see a slowing of growth and ultimately those demand markets for the Magnificent Seven and some of the fastest growing companies in the U.S. And of course, that has an impact on household wealth.
So having said that, Alexis, I'm just wondering, how consequential is this election on the U.S. economy? This is an economy that's been very resilient. Take a look at jobless rate. It is at the lowest level in half a century. Inflation is easing to the level that the Fed wants to see, and the Fed itself is pretty confident of, navigating a soft landing. How consequential is this election?
Yes, no, it's sort of what landing, and whoever takes the White House in January is inheriting a fundamentally healthy economy. And so, as you note, we've seen that. We've seen a really healthy earnings season. We've seen European investors rotate and turn in to U.S. stocks as a result of that. As we mentioned, labor markets being quite robust. We face a labor shortage in the U.S. in many sectors, including construction, including leisure and hospitality. We actually have a very healthy corporate space. U.S. non-financial corporates are sitting on $7 trillion worth of cash. So relatively good shape. We've seen companies continuing to invest in spite of this just, record tightening in the monetary space. And so we do have quite a healthy economy. I mean, one thing that does raise a little bit of concern is America is far down the trajectory of financialization than other economies. And so, one Buffett indicator is that our stock market cap as a percentage of GDP is exceptionally high. And that is something that we think about our valuations a little bit stretched. And as we come into 2025, if we start to see a little bit of slower growth, what happens to those valuations? That's something to keep in mind.
Well, keep in mind as well, fiscal deficit, no matter who comes to power, that remains an issue. Fiscal deficit is quiet until it's not. Yes.
Well, there's three things that Republicans and Democrats agree upon. Fiscal deficit doesn't matter, China and demonization of China, and also energy policy, actually. But on the fiscal deficit, I mean, this is something that previous Treasury secretaries have in their top concerns. But unfortunately, this is not necessarily shared by either candidate or by the legislative branches on both sides of the party bench. So, some estimates that have been put forward, the latest estimates are that the Harris term could actually increase government debt by $3.95 trillion over the next decade. The Trump administration, about a second Trump term, would be about double that in a conservative estimate. And so this is concerning, I would say, for the longer term. It's not necessarily for the short to medium term.
Right. Alexis, before we let you go, talking about risk, Elon Musk, we know that a Philly judge has just allowed, for him to go ahead with that $1 million reward, perhaps for voters. I mean, how are you assessing the risk of that?
Well, what I would really say is this has certainly been a polarized landscape, and we've definitely seen a lot of personalities coming out. And what I really have my eyes focused on is what's happening to the quality of our institutions in the United States going forward. The freedom and the liberality of our financial markets is absolutely dependent upon the vitality of our institutions, and that's certainly something that we will keep our eyes focused on, regardless of who takes the White House.
Alexis, thank you so much for your insights today. Alexis Crow, Chief Economist at PwC US. Well, before we go, here's a look at our guests for Thursday. We'll get insights on the biggest market moves after the U.S. election with Crossmark Global Investments Chief Strategist Victoria Fernandez. And we'll also discuss crypto regulation with CFTC Commissioner Caroline Pham as we monitor the latest swings in Bitcoin. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.